Okay, let us now get into the law of one price and arbitrage. So, this is easy but complicated. So, what I need you to do is this particular video I need you to pay attention. It's not really hard, it's just that it's a little bit complicated, so you're going to have to pay close attention to what we're discussing here. Okay, let's get started. See, first of all, the present value of future cash flows. So let's say there's a payment coming in after 1 month, after 1 year, 2 years, and then 3 years with the face value. And you discount these cash flows back to today, and that gives you the present value. And the price should then be equal to the present value. If the price is not equal to the present value, that means the security is either undervalued or overvalued, right? Let's say the price is less. So there is an arbitrage opportunity because you can buy this, right? And then it will converge. Or you can sell it if it's overvalued and it will give you a lower price. So you will make money because then you'll be able to buy it back at that lower price. That's how short selling works, right? We already talked about that. But that's for one particular bond. Now we might say that how can we link it across different bonds. So let's say this cash flow belongs to another bond, right? And there's another bond which has that exact same cash flow, right? Let's say exact same cash flow. But when I check the price of these two separate bonds, which should be equal because their cash flows are exactly the same, but let's say the price of these two bonds is not equal, right? One of them is lesser than the other one. So I can buy the cheaper one and sell the expensive one. So this is the concept of arbitrage and the law of one price. That if you see that two different securities which have the same cash flows are not selling for the same price, well, then you can buy the cheaper one and sell the expensive one. Now, you must be thinking that how are you going to find two securities which are having exactly the same cash flows? And that is where this gets a little bit complicated, because what we will have to do is then, let's say that I'll take one security, right, which is giving me one set of cash flows, and then I will replicate those cash flows from multiple different securities, right? So if this is my bond, then I'll replicate those cash flows using multiple different bonds, and that really gets complicated because then how much should I buy of each bond? Calculating that is a long calculation. It's not rocket science. I'll take you through it, but it can be fairly confusing and annoying because you have to separately calculate each cash flow. So I'll take you through that. But let's have a higher level look at the concept of arbitrage and the law of one price, and then we will get into the actual arbitrage calculations. So this is going to be a relatively longer video, so bear with me, please. So, okay, what is the concept of the law of one price and arbitrage? You have, let's say, two sets of portfolios. Now we're talking about a portfolio because it's not necessarily just one security is equal to the other security. It could be a bunch of securities equal to another bunch of securities, right? But they both will have exactly the same cash flows, right, at the same time. And the value of those two should be the same. If the value of those two is not the same, then what we say is the law of one price is violated, and therefore there is an arbitrage opportunity. We would buy the cheaper one and short sell the expensive one. And then, of course, what will happen is that when we will short sell the expensive one, it will come down. We'll buy the cheaper one and move it up, and the arbitrage opportunity will disappear, right? So even if in real life the arbitrage opportunity does arise, it is eliminated quickly because then obviously people would buy and sell the cheaper and expensive ones relatively respectively, and then of course the market would converge to the normal level. Now, why would this sort of situation arise in the first place? Why would two portfolios or two bonds which have the same cash flows, why would they be trading at a different price in the market? So maybe it could be because of liquidity difference. So let's say, for example, I'm talking about the US federal government bond. exactly the same cash flows, let's say the California state, Cal state, or Illinois, or any state bond, California state bond. Now, of course, the US government, federal government bonds are much more liquid. So with exactly the same cash flows on the same dates, everything being the same, the price should be the same, but the price is not going to be the same. The US government bond will be a little bit higher than the California state bond, because, or the rate that we will discount this will be at a little bit lower. But the point is that it's almost negligible, right? I mean, even the state of California is almost risk free. So what a company tried to do was that they actually bought the cheaper one, sold the more expensive one, right? And they tried to do something called convergence arbitrage. Now, of course, the US government one is expensive, right? So they short sold that, and the California government, let's say, is the cheaper one, the state bonds, they bought that. And they were hoping that this would go up in value as the maturity date comes close, and this would come down in value and they would converge, because at the end of the day their future value is the same, their cash flows are the same, so they have to come to the same price. Something horrible happened with these guys. What happened was that there was a crisis, right? Russia defaulted, and this company, the long-term capital management, it was one of the biggest companies at the time, one of the biggest funds at the time, it had to go bankrupt, because when Russia defaulted, there was a flight to safety, right? There was a flight to safety, which means people just emotionally started buying government bonds. They started selling everything else and they started buying US government bonds just because they wanted to be in the safest asset, because there was a crisis going on. And this logic of arbitrage convergence didn't work at that time, because there was just an unusual, illogical, irrational increase in the government bond prices. Not because of time value of money or anything else, just because of emotional and behavioral reasons. Right, and then obviously these guys had short sold that, so they lost a lot of money. And they would have been able to survive it if they weren't so highly leveraged. So the amount of bonds they had bought and sold was so huge, and they didn't even have enough money of their own. They were borrowing money and doing it, that a little bit a movement against them, they were not able to actually withstand that, because they didn't have their own money to be able to do that, and they couldn't meet the margin calls. So the point being that even if you're doing an arbitrage opportunity and you're hoping that the prices would converge, right, but it takes time to convert them. There might be movements in the short term which are not moving in that direction, right? You might have the short term movement being a little bit going higher before coming down. So US government and the state bonds, so what they were expecting is that the government bonds would come down, the state bonds would go up, and they would converge. But the US government bonds did come down, but they went up first and then they came down. And this temporary increase was due to the flight to safety because of the Russian crisis. And this company couldn't withstand that. So that's something you have to keep in mind when we talk about arbitrage. But apart from those short-term movements, let's say that we do have the ability to wait and let that convergence happen. So how does one go about doing it? So if you have a bond with a certain level cash flows, right, with a certain future cash flows, and then you want to see how you can replicate another set of future cash flows and see if they are equal to each other, because if they are not equal, then you can have an arbitrage opportunity. So we'll take a bond later, right? We'll take a bond later, and then we will see how we can replicate those cash flows using multiple different bonds, right? Because it's not necessary that you get exactly two bonds with exactly the same cash flows at any given point in time. So what you have to do for an arbitrage opportunity is that you have to use multiple different bonds which are maturing on different dates to actually create that same set of cash flows. So here we're going to look at those multiple different bonds which are maturing on different dates, right? So you've got one maturing on August 15th, and then that's what 2018, and then February 15, 2019, and then August 15, 2019, and then February 15, 2020. And this bond that we're going to see is going to have those exact same dates, right? So it will also have a coupon coming in on 15th of August 2018, and then it will have a coupon coming in on 15th of Feb 2019, and then 15th of August 2019, and then 15th of Feb it will mature 2020, right? So to be able to replicate that, we're going to use these different bonds which are obviously maturing on all those dates as well. Now before we jump into the arbitrage and all this calculation between this one bond and the other multiple cash flows through this portfolio, let's first have a look at how you would get those separate discount rates as well. Because when we talk about calculating the present value of future cash flows, well, if the cash flows are coming on separate dates, you have to use the discount rate accordingly to discount them back. Now you could use one rate, right? But that would be technically not accurate. So what you have to do is you have to use the Z1, which is the 1 year rate, and Z2, which is the 2 year rate, and Z3, which is the 3 year rate for the third year cash flow, because we talked about this, that the yield curve has different rates for different maturities, right? So if you really want to be accurate about this, then you have to know those separate rates for each year. And how can you calculate that? So if we're going to work backwards, and calculate. So for example, if I take this bond, right, it doesn't have like a second year or a third year cash flow. It's maturing immediately right now within a year in 2018. So I can just erase the second year cash flow and the third year cash flow, and I can say, okay, this is going to give me back a face value of 100, right? And it's going to give me my coupon of 4%, but it's semi-annual. All of these are semi-annual. And that's another thing, by the way. I mean, government bonds are usually semi-annual. So 4% would be the annual, which means semi-annual I'll get 2%. So if I'm going to get back 100 plus 2, right, and right now the price in the market is 101.1747, then I can just work backwards and calculate that Z1, right? So depending on how much time there is between now, so this is March, so from March to August, how much time there is, and that's where my numerator is going to come in, and then I can just work backwards and calculate, okay, what is the discount rate? And let me show you, right? So if, for example, this first bond is going to give me 102, right? And right now it is in the market for 101.1747. So actually it is trading at a discount of, the discount factor is 0.9919, right? So this is the discount factor between the current time, which is March 9th, to August 15th when it will mature. Now, I already know the discount for the first year. Now, if I look at the second bond, right, and if I look at its cash flows, now let me just go up and show you what's the second bond. This is the second bond, right? So the second bond is going to, it's trading right now for 100.8071, and it's going to give me half of 2.75%. So 2.75 divided by 2, that's the first year cash flow, and then 2.75 divided by 2 is going to be the, so this is the first 6 months between August to February, and then on February 15th it's going to give me the last coupon payment plus the face value divided by, and this will be the second discount factor, right? So now I already know what is the discount factor for this. I already know what is the discount factor for this payment. Now I need to figure out what will be the discount factor for this payment. And how do I do that? So I'll say, all right, I know that it's going to become 100.8071. And how do I know that? Let me go back and show you again. I know that the price is 100.8071 right now, and I already know the first cash flow, and I know the discount factor for the first cash flow because I calculated that from the first one, right? I already know this, so I can plug that in, into the first cash flow, and then I can solve for the second cash flow discount factor. And then similarly, what I can do is for the third one, I can plug in the first discount factor for its first cash flow, the second discount factor for its second cash flow, and then using its market price, I can calculate the third discount factor. And similarly, I can calculate all four discount factors for these dates, right? So that's one part of the discussion. The second part of the discussion is now saying, okay, now I've got these multiple bonds and I've got let's say another bond, which I'll try and check if their value is the same or not, right? So what we're going to do is we're going to try and replicate these entire cash flows and see if we can check if it's worth exactly the same or not. So let's say there is a bond trading at 112.485, and if I replicate its cash flows using these four different bonds, then what will it cost me to actually replicate those exact cash flows, and is it more or less, and is it different than what this bond is available for? And if it is, then there is an arbitrage opportunity. Now, first of all, to be able to do that, you need to understand what are the cash flows that this bond is offering you. So it's trading for 112.4855 right now. It's a 8.5% semi-annual. So that means it's going to pay you 4.25 on each of these dates, right? And then it's going to pay you that $100 on maturity as well. So you need to now figure out that, okay, exactly what cash flows do I need on which dates? What cash flows do I need on which dates? And this is where it is, that these are the cash flows you can expect on each of these dates. Now we need to use the other bonds that we have to replicate each of these cash flows. Now let's start with the last cash flow. And there is a point I want to emphasize over here. When we were calculating the discount rates for each of these separate bonds, right, we actually started with the first year and then we moved downwards to the longer periods, right? But when we're going to check for an arbitrage opportunity, we're going to work backwards. We're going to start with the last cash flow and then work inwards towards the most recent one. So now let's start with the last one, that we need a cash flow. Now what are we really doing? We're replicating cash flows that we know these are the cash flows that this bond, which is available for 112, that 112 point something, let me tell you, 112.488. So there's a bond which is available for $112.488 right now, right? And it's going to give us these cash flows. So now we're going to try and replicate those cash flows from these four bonds and then see how much money we have to pay for that right now based on these current prices. And then we'll see if it's exactly the same as the current price of this bond, which is also the current price, right? Or if it is different. Now let's start with this last cash flow, 104.25. Now if I want that 104.25 on the same date, 15th Feb, right, I can use this last bond, which is currently trading at 102.75. But how much do I want from that, right? What is it going to give me, first of all, on that date? On the 15th of February, of course, it's going to give me the face value. And it's going to give me the last coupon. So, and it's semi-annual. So 3.625% divided by 2 is actually 1.8125, right? And that is what it's going to pay me on that last date. The 100 plus the 1.8125% multiplied by 100, which then comes in dollars as well. So that's the money it's going to pay me on that date. Now, I need a little bit more than that, right? I need 104.25. So if I take 104.25 and if I divide that by 101.8125, then it tells me that I need to buy not just one of these bonds. I actually need to buy more than one. I need to buy 1.023941 of these bonds because I need to replicate this cash flow of 104.25. And this bond is only going to pay me 101.8125 if I buy just one of them. So I actually need to buy a little bit more of that, right? So now how much am I paying for this? So let's calculate. If the current price is 102.7581 and then multiplied by 1.023941. So I'm going to have to pay for this 105.2182, and look at this, compared to the 112,488, I'm paying 105.218, and I'll get this cash flow, and this bond is going to be giving me something on the 15th of August and the 15th of Feb and on the 15th of August here as well, because this bond is maturing on 2020, right? So I'm going to be getting some money from this bond, but is it enough to cover these cash flows as well? So let's have a look. I'm getting interest of, this is a bond paying a coupon of 3.625, whereas this bond is a coupon of 8.5 annual divided by 2, which is 4.25. So my 4.25 is actually greater than, my 4.25 is greater than the 1.82825. So actually what will happen is that I need some more money to come in and take care of these cash flows as well. So I'll have to use this bond, this bond, this bond to do it. And I have some money available remaining as well, right? Because this bond on the left, this one is currently for 112, and this one which I'm going to buy is 105. So there is still some money that I have left. I can actually buy a little bit of these three to make sure that these three cash flows are completely taken care of. So let's see how much I need to buy of these three and what's going to be the total amount I need to spend for that. So let's focus on the second cash flow now. So for the second cash flow, since I've already bought this bond for the last one, I know that I'll be getting some interest on this 15th of August from this last bond that I have already bought, which pays me 3.625 annually, but divide that by 2 and we get 1.8125 every 6 months. And I haven't bought one of these. I've actually bought 1.02394, of those. So in terms of the coupon payment that I get on this date from the last bond is 1.8559. But I need 4.25. So if I subtract from that, from 4.25, 1.8559, I still need another 2.3941, which I have to get from this bond now. Now this bond is a 0.75% coupon annual, but then again it's semi-annual, so I need to divide that by 2. So it will pay me 0.375, right? If I divide that by 2, that comes to 0.375. Plus it will pay me the $100 at maturity. So the cash flow this bond is going to generate for me will be 100 plus the 375, right? But I don't need 100 and 375. I just need the difference between 4.25 and 1.8559, which is 2.3941. So how much of this bond do I need to buy? I just need to buy a little bit of this, which is just 0.23852, because I don't need that full face value from it. I just need a little bit from it because I just want to make sure that this cash flow of 4.25 is completely replicated, and partially it is already replicated because of this last bond that I bought, 1.023941 of it, right? So I just need to buy now 0.023852 of this third bond, and my second cash flow is then also going to be matched. Now to match my third cash flow, what will I do? Now I need this 4.25. Partially I'm going to get it from the fourth bond that I bought, right? Partially I'm going to get something from the third bond that I bought, because both of these bonds are going to be paying me something on the 15th of February 2019. But that still leaves some amount that I need, right? So how much? So these two combined is 1.8, and if I do 4.25 minus that, so I still need $2.3852, which I have to get from buying this bond, which on maturity will be giving me 2.75 divided by 2 comes to 1.375. So it will be giving 100 par value plus the last 1.375 coupon. But I don't need 101. I just need $2.38. So I divide $2.38 with that 101.375, and now I know that I need to buy how much of this bond. I need to buy 0.02358 of this bond, and similarly I can calculate for the first one as well, 0.02306. You can calculate this yourself, just to make sure you understand the entire calculation, right? And basically what is now happening is that I know how much of each bond I need to buy. So this fourth one I need to buy this much, third one I need to buy this much, second one I need to buy this much, first one I need to buy this much, and that will exactly replicate the same cash flows of the other bond which is currently available for 112. And look at these two. Is it exactly the same? The answer is no, sorry, the one which is available in the market is this one, 112.4855. Is it exactly the same? The answer is no, there is a little bit difference, and if you do a huge trade on this, then you can actually make a significant amount of free money, because there's no risk, right? You're buying one and you're selling the other set. So obviously you will short sell the expensive one, and you will buy. No, which one is expensive? 112.48. Yeah, this one is expensive. So we'll short sell this one, right? And we'll buy these ones. And how much are we going to buy for each of them? You already know how much to buy, right? So you buy those cheaper ones, you short sell the expensive ones, and then you just sit back, relax, and free money. So this is the concept of arbitrage. Let's take a break here. We'll come back and then jump into strips.